And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. It's, of course, Tuesday, again, as we're wrapping up this month, getting ready to close out the quarter, get ready for earnings season right around the corner. That just starts next week. Of course, next week is also a holiday shortened week. It's the 4th of July, which is on Friday. I'll be in London celebrating Independence Day. So I bought a shirt with a big flag on it. It says "Come and Take It" on the back. So yes, we'll be selling Independence Day. Anyway. All good stuff. By the way, I just want to say thank you so much. I had talked about on the radio, on Thoughtful Money with Adam Taggart, that I was going to go see my son in the UK, and I've had just a number of people that have seen that, have emailed me and said, hey, I'm here in the UK. I know where Sleaford is, which is where he lives right now. If he ever needs help, here's my information. I really appreciate that very much. It's when you have a child living overseas, they're just kind of on their own. Now, he's very independent. He won't take help from anybody, but it's always good to know. So I do appreciate the outreach very much. It's very appreciated. All right, so looking at today, markets are going to be opening up fairly sharply on the end of World War III. So, it's been very interesting that, the narratives, and we've spent a lot of time here on the show talking about narratives this year because there's been so many of them. We've had the whole debt deficit narrative, right? That's going to, the markets are selling off because of the debts and the deficits. And so, that was that narrative. Then we had the whole tariff, Liberation Day. We had the Moody's debt downgrade, right? That's the end of the world as we know it, right? Then we had, of course, Iran and Israel, and then, of course, yesterday the markets rallied, after the very muted response from Iran back onto the U.S. airbase in Qatar. Basically they telegraphed, said, hey, we're going to attack this base, and they did, and everything was taken care of, and it was a very muted response, and the markets took that very well. And so markets rallied yesterday, and did well. And then today markets are rallying again, despite the fact that this morning there's, the headlines are is that Trump's not happy with Iran and Israel because there was a last minute spat. Iran sent missiles into Israel last night. But the market's really kind of already looking past that as well. So again, the point is that I've seen so many videos, article headlines, etc. about, this is going to be World War III, but China and Russia have not said anything, right? I mean, they've stayed out of this whole issue with Iran at this point. It doesn't mean that they won't eventually get involved, but right now it's been nothing. And so all these concerns, all these narratives, right, that were driving the markets and were supposed to lead to this big major correction has not happened. And furthermore, despite the fact we've been, kind of saying, look, markets overbought here, we're going to get a pullback at some point, you want to buy the pullback. We haven't really got much of a pullback. We got a little bit of a pullback. It's not much. But it's probably all the pullback we're going to get because we're about to enter into earnings season in July. July tends to be one of the stronger months of the year. The last couple of days of June tend to be fairly strong because of portfolio rebalancing generally. So there's a lot of things that are kind of suggesting that maybe this little bit of a correction that we had over the last really kind of few days is maybe all we're going to get. Now, there's, again, as is always the case, when you're looking at specific stocks in your portfolio. So again, this depends on how you're investing. If you're buying an ETF and just buying a passive index like the S&P 500 or a sector ETF, you have to look at everything independently, right? Is it really oversold? Is it beaten up? Those type of things. Is it a good entry opportunity? When you're looking at individual stocks the same way, we can look at the overall market and say we didn't get much of a pullback, but there are stocks in the index that have had decent corrections, and there's actually some opportunities kind of showing up to add positions to your portfolio, something we're probably going to be doing today, tomorrow. But again, these are opportunities that you have to kind of dig for. So it's always important to separate out these narratives, right, that affect kind of the broader index versus what's happening underneath the surface. And again, as we kind of look below the surface of the market, things have providing some opportunity to put some capital to work. But here's what you need to know before the bell this morning. So yesterday it was interesting because, as I noted, markets were under a bit of pressure early in the morning because of this whole, we bombed Iran, took out the nuclear plants. They were telegraphing a reaction to that, which occurred. Turned out to be pretty much a nothing burger. Market sold off initially during that kind of attack when it was happening, and then rallied into the end of the day, and it was actually up almost 1% by the end of the day. But technically, we were forming this kind of bull flag in the markets. We had this consolidating, kind of slightly downward wedge. Again, this was that kind of correctional point in the market. We were getting a little bit of a pullback here, got down to the 20-day moving average, and then yesterday the market rallied, broke out of that bull flag. So that is bullish from that standpoint. And so we've kind of taken that consolidation, broken out of that this morning. Futures are pointing decently higher. S&P right now is up about 69 bips. The S&P's up about 60. NASDAQ's up about 88 bips. At the moment, because again, we're going to see kind of money flows coming back into the markets today, at least at the open. Now, whether or not we can continue to hold that throughout the day, that's going to be the next question. But this kind of breakout of this little minor consolidation that we've had, this little bit of a pullback, is certainly bullish at this point. So it certainly suggests, again, after holding support at the 20-day moving average, that's important. Also, we held support at this previous top. So we had this previous top that we had set during that Liberation Day rally. The market had come back down, tested the 200-day moving average. Good, successful retest from a bullish standpoint. We then broke out of that top. So we broke out of that resistance. So we had this breakout. We retested that breakout yesterday as well, bounced right off of that. So again, multiple levels of support here where the market continues to hold its footing. It's still in a very bullish stance as we begin to wrap up the month. And again, historically speaking, the end of June, the last few days of June tend to be bullish, and then July tends to be a fairly strong month. So really, for the most part, what we're talking about now in the market is that unless something happens that creates a bit bigger of a downward pressure in the markets, we're likely going to get a push higher in the markets back towards all-time highs, or at least 6,100. That would kind of be that kind of the next level of resistance in the market. So there's not a tremendous amount of upside, unfortunately, from where we are right now, but things are improving, technically speaking. So there is some upside here. There is still really, on a risk-reward basis, the upside-downside kind of range really doesn't play out well for investors. Again, your downside risk is down to 28 to 5,800, which is where the 200-day moving average right now, and you got 100 points of upside, technically speaking. So again, the risk reward's not great here to be super aggressive, but it's also doesn't mean that we can't, go to 6,100, then 62, 63, 64. It just depends on what happens here with the markets. But again, there are some certain things to be paying attention to, right? Economic growth is slowing. We still have a Federal Reserve that's kind of standing pat on not reducing rates at this point. There's certainly some other risks to the markets as we get into into August, September, October, seasonally very weak months of the year. So again, I would still remain cautious here, but if you're looking for some opportunities to add stuff that's been beaten up here lately, might be some opportunities to pick through your portfolio and see kind of maybe some areas you're missing, maybe some opportunities that exist. But just as always the case, move cautiously, move carefully, but the upside to the market is certainly probably the case right now. The market's probably going to try to move higher through the end of the week and into July. That, statistics speaking, doesn't mean it has to happen, but something that usually does. So again, just as an investor, want to try to take advantage of it as best we can. So all right, that's what you need to know before the bell this morning. We'll come back, pick up with the show, and don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So, interesting comment in chat right now, talking about Apple. And the question was, is Apple dead? It's not growing. And this is one of the interesting problems with the markets that exist today as an investor. This is one of the issues you have to deal with as an investor, is that there are some stocks that are going to rise in price regardless of their fundamentals. And that may be kind of hard to wrap your head around a bit, but it's just because of the way that money flows into the markets today more than anything else, that sometimes fundamentals don't have as much of an impact as you think they should. And for instance, if you take a look, this is, let me just show you real quick here. So this is these bar charts. Just pay attention to the bar charts. This is the first bar chart is earnings per share on the left, sales per share, or sales in billions, in the middle, and shares outstanding on the right. What you'll notice is that over the last really 4 years, earnings per share have not grown. Sales are completely flat. Yet the stock continues to do well despite that over the last 4 years. And you know, it's been lagging a little bit here lately, but overall it's done well. Despite the fact that fundamentally it's expensive. I mean, it trades at a price to sales ratio that's, you know, very high. You know, it's again not really growing its revenue. It's a big giant company, but it's not really growing its revenue. So how do you quantify that? Why is the stock doing so well when the fundamentals really aren't? And that's because of its weighting in the S&P index and its participation in, you know, actively traded ETFs. And there's so many of these now. In fact, money flows into actively traded ETFs is now outpaced the money flows into passive index ETFs. So for a difference, to understand the difference, if you buy SPY, which is the S&P 500 index, that's a passive index. You're just basically getting the index. And Nothing changes in the index unless something happens in the index. Company goes bankrupt. There's this, they take a company out of the index and put another one in. It's called substitution. And I've got an article on this coming out in the next week or so, talking about why you shouldn't benchmark your benchmark your portfolio to an index. And it's because of these factors that happen in an index that have nothing to do with your portfolio. But for the sake of this conversation, that's a passive index. Then there's a lot of ETFs that are out there that are like MTUM, the momentum ETF. That's constantly rearranged based on momentum statistics of stocks in the index. So stocks have the highest momentum are in the ETF, then they come out of the ETF if they lose momentum. So that's actively traded. Those types of funds are now dragging in more inflows than passive indexes. Now, why is that important? I haven't checked the statistics lately, but I wrote about this previously. And at that time I wrote about it, there was like 420 ETFs that owned Apple. So every time somebody buys one of those 420 ETFs, they also buy shares of Apple. Same thing goes with the S&P 500. Every time somebody throws $1 into an S&P index, about 5% of that dollar goes to Apple because of its weighting in the index. And this is the whole issue with not just Apple. It's also the whole issue with the Mag 7 or the top 10 stocks in the ETF. They own, like right now, the top 10 stocks make up about 35%-ish of the S&P 500. So 35 cents of every dollar that goes into the ETF goes into those 10 stocks. And that's why they continue to dominate. And so and that's okay. There's nothing wrong with that. But that has nothing really to do with fundamentals. It's just money flows. And when you have all this money flooding into the markets, it is gravitating towards those stocks. They're just kind of like the Hoover vacuum cleaner of money. They're just like sucking it up as it comes in. And so that continues to push the price up. So it's not surprising that just, for instance, over the last 2 days, the market's rallied a little bit and Apple's rallied over the last couple of days. Not a lot, but a little. And that's just simply that effect of money going into ETFs that's now dragging Apple stock higher. So the question is, right, is how do you invest in that? Because fundamentally speaking, we sold Apple in our portfolio. We've owned Apple for a long time, but we sold Apple in our equity model because of the fundamentals. They're not growing. So we're going to swap Apple for a company that is growing, that is also in the Mag 7. So we're still getting the benefit of the passive indexing effect in our equity model portfolio, but we have removed a position that is not growing its earnings and revenue from a fundamental perspective for a company that is. So we've sold Apple. We haven't made the swap yet, but we will eventually make the swap. But this is the challenge that you have with your portfolio. Here's the problem that individual investors face in their portfolio. If you want to, you see a lot of articles about, it's like, well, if you're not beating an index, you should just buy and hold an index. It's nearly impossible to beat an index over time as an individual. And the reason is that because for you to do that, you've got to have the vast majority of your portfolio in 10 stocks. And that's a challenge. Weighting becomes a problem. The size of your portfolio is problematic. There's a lot of other things that go on. You're also having to take on a lot more risks than you may be willing to take on in order to try to beat that benchmark performance. Also the fact, and again, this is in the article, your portfolio, you've got to pay income taxes, you've got to pay fees, you've got to pay expenses. None of that occurs in an index. So this is why I've talked about before is that the worst thing you can do as an investor is to match your portfolio to some random benchmark index. Don't worry about the index. Worry about how your portfolio is performing. Is it performing up to your standards and your needs? Is it meeting your goals? If your goal is 4% a year, build a portfolio to generate 4% a year. Because if you want 5% a year, it's like, it's just 1% more. That's a 25%. That's a 25% increase in the return that you want, but that's about 100% increase in the volatility risk you've got to take to get that. So just small increases in the rate of return can vastly increase the volatility of your portfolio, which is fine as long as markets are going up. But as soon as markets start to take a big dive like we saw back in April, that's when I start getting the emails and phone calls like, oh my gosh, what am I going to do? Right? I'm losing all this money. Volatility is important. You have to manage that. But back to Apple, you know, the fundamentally the company's not growing. They just recently had their reveal of their new products they're bringing to market. It was nothing exciting. There's nothing groundbreaking or earth-shattering or, you know, innovative, you know, other than including AI into your search features, which everybody's doing right now. But there's really nothing exciting going on. There was no new innovation coming out of Apple that was like, oh my gosh, I've got to go get rid of my $2,000 phone I've got now and go buy another $2,000 phone, right? There was nothing that really driving that. Now, if you remember back in the day, and what's funny is, you know, say back in the day now we're talking about 2007 when the iPhone first came out. You know, it's funny because now that's old news, right? It's like, oh my gosh, way back then, you know, before the turn of the century, when Brent and I were much younger. Brent had a lot more hair back then. We were walking around with these Motorola brick phones that were like this big, had a big antenna on it. And then, you know, Apple comes along and they bring out this smartphone. It's like, you know, there was a BlackBerry before there was a smartphone, right? So BlackBerry was the thing for a while. Everybody was walking around. If you were in finance, you had a BlackBerry. And then, of course, the smartphone came out. And that was revolutionary. When the Apple iPhone first came to market, that was revolutionary. It was like, oh my gosh, this is a game changer. BlackBerry died on the spot. And everybody switched over to, you know, Apple. Android and Apple. Those were the big changes. But that was a revolutionary breakthrough in cell phone technology. We're not seeing that now. Which really brings to question, you know, the growth prospects for Apple going into the future. Now, again, are we talking about fundamentals? Or are we talking about benchmarking? This is the question that you've got to determine within your own portfolio. If your goal is to pace a benchmark and you want to own equities, you kind of almost need to add Apple. You almost have to own Apple or some relative variation of Apple in your portfolio to get enough weight so that your portfolio can track the index when the market moves, because when the market moves, these stocks are going to move with it in most cases. Now, look, there's going to be periods where they underperform a bit, like you know, they had 2 great years in a row. They're underperforming a little bit this year. They're consolidating, rebasing. But when this market takes off again in a seriously strong rally, those stocks are going to pace the way because of their weighting in the index. So you have to really come back and determine what it is in your portfolio that you're trying to achieve. And that will determine whether or not that you need to own these stocks or not. And we'll talk a little bit about the dividend equity model when we come back, just because it's a good example of what we're talking about. We'll touch on it when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors, online resources, and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife's traveling. She's in Quebec right now for work. She called me up. She goes, everybody speaks French up here. I go, yes, honey. They're a French colony. She goes, I never knew that.
The Real Investment Show podcast. Same show, your schedule.
So the company that she's with took her out to dinner last night. They go to this very nice French restaurant. The appetizer comes out, which is bagua. She goes, that's duck liver, isn't it? Yeah, the rest of the dinner was downhill right from there. So
at realinvestmentadvice.com.
And the only thing that made it better was when they brought the snails out.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. So, just before the break, we were just talking a little bit about, the issues with benchmarking and, specifically about Apple. It was just a comment that was made in chat about whether or not that, is Apple, because it's not growing fundamentally, is it still, a company to own? And from a purely fundamental basis, if you're just strictly looking at the fundamentals, it's less appealing. However, as I said, you almost kind of have to own it if you're going to pace the benchmark. And so, like for instance, we own a dividend to equity model that we run, and the goal of that model is to provide. Now, there's different ways to structure a dividend equity model. A lot of times, you know this as the dividend aristocrats. Which are the some of the companies with the highest dividend yields in the in the index, et cetera. And those are okay, right? But a lot of times you get a lot of underperformance in that because those stocks aren't in the driver's seat of the momentum. When you have a momentum-driven markets, a purely value-oriented dividend-yielding model will underperform to a large degree. But yes, you're collecting the yield, et cetera. So when we structured our dividend model, we broke it into two halves, or two parts. Really, it's 1/3, 2/3. And we put 30% of the portfolio in basically 6 of the top 10 stocks in the S&P 500 that they don't really provide any yield of any sort. little bits, but not a lot. The whole purpose of that portion of the holding is to provide S&P index performance. That's it. That's the whole reason for it. So when people are investing capital into the markets, the dividend equity model is getting that traction. So it owns NVIDIA and Meta and Apple and those companies. And so that provides the performance side, because what we need to have occur, and we talked about this previously about building portfolios to generate, target rated returns over time, is that with 5% bonds, you don't have to stretch a whole lot to generate a 5% return in your portfolio. So how much risk do I need? Well, the problem with owning all bonds, right, is that the interest income doesn't change over time. So it doesn't adjust for inflation. So you need an inflation adjustment component in your portfolio to adjust your dollars today for what the dollar value will be in the future. This is the big fallacy with, if you just, invest in a Roth IRA, for the next 30 years, you'll have $1 million when you retire. Well, $1 million in 30 years from now is going to be like $100,000 today. It's not going to buy you a lot. So, getting to the magical $1 million benchmark isn't what it used to be back in the 80s, right? We all want to be millionaires, but being a millionaire, having $1 million really is not going to carry you very far today just because of the cost of living. And that's going to continue to grow as the economy grows in the future. So in the dividend equity model, we need that growth to adjust for the dividend income we're getting from the dividend yielding stocks in the portfolio that won't grow as fast as the overall market. So it's going to grow, right? Those stocks will grow, but they're just not growing as fast as the market because these are, it's Coke, it's IBM, it's Procter & Gamble, it's those types of companies, right? They're slower growth companies, but they provide nice, healthy, juicy dividends. So the equity model provides, about a 3.75% dividend yield, but provides better growth because of its weightings to those S&P 500 stocks. So it's just a different way to model it. And again, you can build your own portfolio however you want to build it. But again, what we step back to is, what is your goal, right? Don't pay attention to the markets. Don't pay attention to an index. It doesn't matter what the S&P 500 does. The only reason we track it for you every day and we say, hey, this is what the markets did yesterday, is just to kind of let you know where we are. Do we have less risk or more risk in the market? That's all I really want to know is, am I at a juncture in the markets where risk outweighs reward to a large degree? Remember back in March, we were talking about, hey, reduced markets are really overbought here, really extended. Everybody's kind of overly, aggressive. Take profits, rebalance risk, and then you had the whole April decline thing, right? And then at the bottom of the April decline, we're talking about, hey, this is time to kind of add money to markets, et cetera. It's still risk, still got to be careful here. But we're talking about adding to stocks that we wanted to own in our portfolios back on early April. So again, the measuring the volatility of the market's important to understand how much risk you have in your portfolio. But at the end of the day, what the goal is to say, what do I want my portfolio to do? Because again, each incremental increase in the rate of return that you want to get out of your portfolio requires a geometric increase in the amount of risk you got to take to get it. 4% to 5% doesn't sound like a lot, but to go from a 4% rate of return to a 5% rate of return, or from 5 to 6 or 6 to 7, requires an exponential increase in the risk you take to get there. And then when you start asking for above historical average rates of return in your portfolio, well, I want 10 or 12% a year. You've got to take on an excessive amount of risk to get that. And risk is okay as long as everything's working for you. As long as everything's moving up, risk is fine. It's when things go wrong. Risk is not about how much money you make. That's what Wall Street tells you. Well, the more risk you take, the more money you make. That's what Wall Street tells you. But that's not risk. Risk is how much money you lose when things go wrong. Jump out of an airplane without a parachute, that's a risk. I used to use that example all the time until a guy actually did it and then had a big net he fell into successfully. So now I can't use the whole risk analogy anymore. But there's things that we do. We go, man, that's kind of risky, right? Let's go swim with sharks, right? That's kind of risky, right? As long as nothing goes wrong, you're fine. But just in case, you have to sign the waiver. Risk is not about how much you gain out of something. Risk is about how much money risk is how much you lose, right? And the riskier the adventure is, the bigger the waiver you've got to sign. Same thing with the markets. So you can certainly try to chase more return in your portfolio, but you're taking an exponentially increased rate of risk to do that. And again, it's all fine and dandy as long as markets are going up, but I can tell you as soon as the markets go down, you're not going to like it. And I can tell you that by all the emails I get. When, back in April, we were flooded with emails from people about, oh my gosh, when's this ever going to stop going down? It'll stop going down and it'll eventually go back up. The question is can you survive that process? Did you sell at the top so that you have some money to buy with the bottom? And when we talk about selling tops, right, we're not talking about selling the exact top. We're just talking about raising some capital, raising some cash, reducing some risk when markets are really overbought. So we have that money available to buy with when we get a better opportunity in the future. That's just risk management, right? That's all we're talking about. Another question in chat this morning was the Dow Jones Transports is not confirming this recent rally in the markets. It kind of is. Here's a chart of the Dow Jones Industrial Average versus the Dow Jones Transportation Average. The Dow Jones Transportation Average is in blue, and the Dow Jones Industrials is in red. Now, you can see that there's a decently high correlation between the two indexes. And the thesis is that if your rally in the Dow Jones Industrial Average is valid, right, transports should be leading the way because transports are a reflection of the underlying economic growth in the economy. Now, Dow Jones is rallying here. The transports are rallying as well. Now, it certainly hasn't broken out to an all-time high. Neither index has lately. But, there's certainly participation in both indexes. The problem that I have with this old adage is that the Dow Jones Industrial Average isn't the Dow Jones Industrial Average anymore. Back in the day, the Dow Jones Industrial Average was industrial stocks. General Electric, Bethlehem Steel, those type of things. It's not that anymore. It's now Microsoft, Apple, right? It's technology. It's other companies in there. Nvidia is now in the Dow Jones Industrial Average. So it's not really so industrial anymore. But that doesn't matter. The idea is that what we need to be seeing is strength within the economy, which should be represented by the Dow Jones Transportation Index. Because if the economy is growing and doing what it's supposed to, we should be shipping product, putting things on rail cars, etc. And that tells us that earnings should be growing as well, right? And that's kind of supportive of that. So historically, that relationship is significant when railroads really kind of dominated the transportation and the economy was heavily industrial. But its usefulness today is somewhat depleted because of different modes of transportation, airlines, et cetera, versus rail. But also the reconstruction of the Dow Jones Industrial Average, because the people that drive the Dow wanted it to perform better to keep up with the S&P. So it's not so industrial anymore. It's more of a mini S&P fund. Anyway, we'll wrap up this conversation, come back from break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So just getting ready to wrap things up. President Trump saying this morning that both Iran and Israel have now violated the ceasefire. But it's shocking, I tell you, shocking. Hopefully things will get back in line. Market's really not paying too much attention to this at all. The Dow Jones right now is implied open on the Dow is up 308 points. S&P is going to be up about NASDAQ will be about 234 this morning, and we'll have the S&P up about 40, 45 this morning. So, gold is down this morning because basically the need for a safe haven is kind of evaporating at this moment. This is the premise, right? Things come down, don't need to be in gold because World War III is not going to happen. Bitcoin's up this morning because it's a speculative bet on the S&P. So as markets rise, Bitcoin goes up as well. So again, just kind of overall, it's the flights to safe haven are reversing. So dollar down, gold down, markets up. It's just kind of the risk off back to risk on with kind of the headline news. So again, but this is just for today. We'll see what happens next. Again, we've got some other things that are coming up in the next few days. Again, as we wrap up the month. We've got end of the quarter rebalancing. If you take a look at CTAs, the computerized trading algorithms, right now, those are more in sell mode than they are in buy mode because of the rally. So we've got some issues there kind of coming into the month. The question is whether or not do pension funds need to buy equities to get their portfolios in balance, or are they overweight equities and have to sell some going into the end of the month? We'll see, right? We'll figure that out by the end of the week. But then we start the 1st of July. You'll get managers putting equity positions back on. New quarter. Want to own all the right positions for the quarter. So you typically get buying in the first few days of the new quarter. So that's July. But again, next week's a holiday shortened week. And then you'll get into earnings season basically in the second week of July. And then the buyback blackout window opens back up around July the 18th. And so corporate buybacks will start to come back in because that by the time we'll have The banks will have reported, so they'll start buying, and then shortly after the banks report, we get Apple, Microsoft, Google, and then they can start buying. So again, that's kind of why July tends to be a little bit better performing month, historically speaking. And then we get into August, September, October. This is getting kind of far out there, but I'm sure we'll have another narrative that we're talking about at that point. Markets are selling off because of A, B, C, or D, whatever the reason is. We'll cover that when we get there. But that's kind of the layout here for this summer. A little bit more volatility, not surprising. Rally in the meantime. Could hit all-time highs here before we actually get into another period of sloppy trading later on in August, September. The other things to basically just kind of be focused on is, kind of again, back to Fed policy. And I've got an article coming out on Friday talking about how the Fed has now got themselves trapped once again by looking in the rearview mirror. And I did a interview yesterday with SOAR Financially that, he was asking this kind of same question was, well, the Fed's holding rates on hold and should they be cutting here? And the answer is yes, they actually should be cutting. If you take a look at the economic data, it's clearly slowing down. The employment data is clearly slowing down. And at a decently rapid pace, we're seeing employment growth slow down. Now, could that change? Sure. But over the last few months, we've seen fairly negative revisions to the employment data. And the latest report was only 139,000 jobs. That will likely get revised down in the June report, which we'll get in early July. When we get that employment report, don't be surprised. I'm not saying it's an absolutely guarantee, but it's very possible we could see that 139 revised down closer to 100,000. And that's certainly fairly weak growth. The Fed should have cut rates at the last meeting for a whole variety of reasons. If you just take a look at the economic data, the inflation data isn't present. The employment data is clearly slowing down, which is going to lead to lower rates of inflation because people have less money to spend if they're not working. So there's a lot of disinflationary impacts that are currently occurring in the economy, and they should be cutting rates considering that inflation's at 2.4%, 2.3, and the Fed funds rate's 4.3. Those two should be closer together. So monetary policy remains fairly restrictive relative to where the economy is, but they're focused on this concern about tariff-driven inflation, which we haven't seen yet. And this was their last meeting, which was, we haven't seen the tariff inflation, but we think it's coming. And this is part of the problem with the Federal Reserve is that they're always using the rearview mirror to try to predict what's going to happen in the future. And even Jerome Powell says is, hey, we're forward looking. We're trying to guess what's going to happen, and that's never worked out. The Fed has never done a good job guessing at what's going to happen. They're always wrong. And you go back to 1999. That's where Alan Greenspan was talking about, he was worried about the inflation boogeyman that was hiding in the bushes. And he was hiking rates going into 2000, concerned about this inflationary, kind of issue that was sitting out there and didn't occur. But what rates did do was help unwind a lot of the dot-com bubble. Then in 2007, Ben Bernanke's hiking interest rates going, hey, don't worry about subprimes contained. It's no big deal. Don't worry about it. And then we have the financial crisis. 2018, September, Jerome Powell's hiking interest rates going, hey, we're nowhere close to the neutral rate, 20% down later and 3 months later. He's like, okay, well, we're at the neutral rate, even though they hadn't raised rates anymore, right? And then in July, he's cutting rates in 2019 because of the whole repo crisis. Then in 2020, we're cutting rates to zero and doing $120 billion a month in QE because of COVID. Then we have this massive surge of liquidity coming into the markets, and they didn't see the fact that when you shut down the economy and sent checks to household, that was going to create inflation. We were talking about, it's like, this is going to be inflationary. And exactly what happened. So they should have been in 2020. As soon as GDP jumped 30% in a quarter, they should have been hiking rates and getting QE to zero. But they didn't. They kept that on for way too long, which created that inflationary surge that we saw of 9% going into 2022. And so now they're talking about, well, we're worried about inflation showing up again because they're so traumatized by the mistakes that he's made over the last really few years on being on the wrong side of the curve each way. He's now not cutting rates when he should be because he's worried that this inflation boogeyman is going to come back. So what will likely happen is at some point, and you can see this in the economic data, we're going to get some weaker economic print at some point, and they're going to have to start going into hyper cut mode and be cut. Well, we're going to have to cut by 50 basis points, not 25, to play catch up. But again, this is the problem with the markets right now, is that the markets are so focused. And this is really the interesting, we were talking about the markets earlier and this whole, kind of drive by investors to get into, actively traded ETFs, leveraged single stock ETFs, leveraged single stock ETFs, things like the MicroStrategy's 2X lever. Leveraged ETFs, 2-for-1 S&P, 2-for-1 NASDAQ, 3-for-1 NASDAQ. There's so much push by investors to get into more speculative investments that the risk of something breaking at some point is rising. Now, again, this doesn't mean you're going to have a 50% correction in the market. It's not that at all. But you're going to have a decent correction at some point. And this is going to really put the Fed on their hind heels, because now you're dealing not only with a market correction that's starting to impair the banks, but you've also got this economic weakness that will show up in the economy because of that correction that all of a sudden leads to a faster need to cut rates. And again, this is why the Fed's always behind the curve, because they're looking in the rearview mirror and using that data to predict the future, which that's old data. They should be looking at data that's more real-time in nature, that's actually predictive of market outcomes, and they don't do that. But that's just my opinion, right? History says my opinion is right, but it's just my opinion. Agree, disagree, doesn't matter. But I think they're making a mistake, and I think that eventually that mistake will show up in the markets. But again, the Federal Reserve, which shouldn't be a public figure, right? Back, again, before the turn of the century, nobody knew outside of people on Wall Street who Alan Greenspan was. If you walk down the street and ask the average person, who's Alan Greenspan? I don't know. Ask anybody today who the head of the Federal Reserve is, Jerome Powell, Janet Yellen. They can name them off, Ben Bernanke. Because they've become now public market figures, because they have decided that as the Federal Reserve, which should be this kind of shadow organization in the background just controlling, monetary policy for the banks, they've now become front and center of monetary policy for the markets because of their intervention since 2008. And now the whole market has been trained to invest and buy stocks based on Fed policy. Oh, is the Fed cutting rates? And this is why every meeting is like everybody watches the Fed meeting. What are they going to say? If they cut rates, the markets go up. If they don't cut rates, the market goes down. What are we going to do? This is just that speculative nature that we've now ingrained into the markets that's now shown up in it. But that also, as we go back to talking about previously about managing your risk, that speculative drive into the markets is the risk that's building in the markets. So again, just manage your portfolio accordingly. Meantime, be sure and get signed up for this weekend's Financial Independence with Danny Ratliff. We're going to talk about Iran, Israel, debt, deficits, all the big narratives we're going to cover this weekend. Talk about your money on Saturday. It's Candid Coffee. So sign up now at the website, realinvestmentadvice.com. Get our latest post on X as well as Substack at Lance Roberts, and have a great day. See you back here tomorrow.